Hey, what's happening, guys? Dan Darrow here from Options in Play. So today I'm going to talk about what the mental steps are that I go through when we get a down open and you're sitting in call positions. Okay, and specifically, I'm going to talk about shorter term call positions or shorter term bullish positions. All right, because as you go out to like different expirations, longer term expirations, it's going to be a little bit different how you manage those. All right, and they probably won't see as severe of a hit on down opens like you would with like these short term options, right? So really today I'm going to focus just specifically on short term options. All right, and obviously you're sitting in calls, you get a really big down open. It's not a great morning, right? So really, what it comes down to is having some sort of plan in place with knowing how you want to manage those contracts, which contracts to manage, right, and which ones to hold on to, right? And I have kind of like a two-step process, maybe three. You could make the argument like a three steps, so like two and a half. Um, and it really kind of like simplifies my strategy when we get these down opens. All right. First thing, when I'm looking at the position, what I want to know is like, does that contract go through a catalyst? Okay. So is it going to go through an earnings report, or if it's like biotech, maybe like drug data? Because theoretically, those positions, so those contracts should hold on to the value better because of that catalyst. All right. So, for instance, I'm just going to do like hypothetically a couple examples here. So AMD, right? So say you're in like a couple week out options on AMD. It got hit today and it opened below the 20 days. I'm going to talk about two chip stocks, AMD and Skyworks, just to kind of illustrate the point here. So say you had short-term options on AMD to open below the 20-day. Now the thing with AMD is that they report this week. So yes, the calls probably took a hit, probably a pretty sharp hit because the stock opened down a decent amount. But if you're thinking of holding into earnings and that was your plan all along, then really like the thesis hasn't changed, right? Because yes, the contracts took a hit, but earnings are still there. Like the premium for the catalyst is still there, and theoretically, like the trade could still work out because you have that significant catalyst coming up later this week, right? So those I'd probably be more interested in maybe like giving a little bit more room holding on to because the thesis, the reason to being in the trade hasn't changed, and the contract should still hold on to a decent amount of premium because of that catalyst. All right. Now, Skyworks is a different story. Skyworks reported last week, and similar to AMD, it gapped below its 20-day. Now, say you had options calls maybe like 2, 3 weeks out, very similar to AMD. Now, whereas AMD has a catalyst, Skyworks doesn't have a catalyst, so those options are going to get hit pretty hard, right? And whereas AMD kind of similar in the sense that it opened below the 20-day, puts it in a bad technical position. Skyworks opens below the 20-day as well in a bad technical position, and it doesn't have that catalyst. It doesn't have that major event coming up to potentially like drive the stock materially higher, right? So with like a key stop level having triggered, right? So like that factors into it also, like that technical pattern. So with the key stop level having triggered, I'd be probably more interested in managing or closing Skyworks because it doesn't have that catalyst, okay? Whereas AMD has a catalyst, still has the thesis for the trade. Skyworks, this was probably just a swing trade, right? So it broke support, it has no catalyst, and the reason for the swing trade has really been removed. So like those would be options I'd be more interested in managing on that down open, all right, versus the AMD, which still has the catalyst, and the thesis still remains in place, even though it did get hit pretty hard, all right? Now, kind of like I said, like two and a half to three. So the last thing to consider is whether the position has already been managed. All right, and what I mean by that is has it already been rolled up? So say for instance, Skyworks. We'll keep using this example. So say maybe you entered this a little while ago, like maybe 2, 3 weeks ago, and the stock has moved up in your favor. You were able to trim back the position, right? Maybe you were able to sell some calls, lock in a gain, or maybe you were able to close out the original contracts and roll up to like a further out of the money contract. But like the theme here is that you were able to reduce risk already, right? So like the current position is not the position you started with. You'd already taken money off, or maybe you've rolled up to like a lower debit contract, something along those lines, right? If that's the case, then I might be willing to hold on to that position a little bit longer or give it a little bit more room because risk has already been reduced, right? So even though it got hit hard, it doesn't look great technically. It's losing a key area and it doesn't have that catalyst. It's already been managed once, or maybe it's multiple manages, right? So the risk has already been reduced. So I wouldn't mind, in some instances, holding on to that a little bit longer to see maybe if it rebounds, give it a little bit more room, just because again the risk has already been reduced, the contract has already been rolled up. Maybe you already took off like 25%, 50%, what have you, right? So like that's like a deciding factor too. But like these are the things that are going through my mind when I'm in shorter term positions. Again, these are like shorter term contracts. When you get like a pretty significant down open, right? So like this is kind of what's going through my mind. This is really what determines like which positions I'm managing, which ones are more urgent for me to manage, right? Which ones I have like a greater focus on. And I just wanted to share this because if we're going to get a pickup in volatility, especially in the near term, this is something that's probably worth covering, worth going over. So I hope it's helpful. All right. If you like these videos and you're looking for more information on options trading or options education, please follow up with the link in the description of the video for more information on options to play. All right. Have a great night, and I'll talk to you all soon.